Hello everyone. Welcome to the Stock Minds web channel. The Progressive Corporation, NYSE, PGR, has demonstrated impressive financial performance in Q1 2025, solidifying its position as a leading player in the insurance industry. With robust earnings growth, strong cash flow, and a favorable valuation, Progressive presents a compelling investment opportunity for those seeking both growth and value. In this video, we will dive into Progressive's recent earnings, stock performance and valuation, growth potential, and the risks investors should consider. About the Progressive. Founded in 1937 by Joseph Lewis and Jack Green, the Progressive Corporation is headquartered in Mayfield Village, Ohio. As the second largest auto insurer in the United States, Progressive offers a wide range of insurance products, including personal and commercial auto, motorcycle, boat, RV, and home insurance. The company operates through three segments: personal lines, commercial auto, and other indemnity, serving customers through direct channels and a vast network of independent agents. Progressive financial performance. Progressive's financial performance in Q1 2025 reflects its strong operational momentum and consistent growth trajectory. The company reported quarterly revenue of $20.4 billion, marking an 18.36% increase from $17.23 billion in Q1 2024. Earnings per share for the quarter reached $4.37, representing a 10.91% rise from the previous year's $3.94. On a trailing 12-month TTM basis, revenue surged 20.74% to $78.5 billion compared to $65 billion in Q1 2024, while TTM EPS grew significantly by 51.82%, climbing from $9.77 to $14.83. Free cash flow per share also showed notable strength, increasing 29.26% year-over-year to $26.77 from $20.71. Profitability metrics remain solid, with a gross profit margin of 14.98%, a net profit margin of 11.1%, and a robust free cash flow margin of 20.04%. Additionally, Progressive boasts a strong return on assets of 6.86% and an impressive return on equity of 34.34%, supported by a conservative debt-to-equity ratio of just 0.24. Over the past 5 years, Progressive's revenue has grown at a 16.6% CAGR, net income at 10.6%, and free cash flow at 22.3%. Progressive has grown steadily each year, and the rapid growth of free cash flow is exceptional. Progressive Fiscal 2025 Financial Forecast. Looking ahead, analysts project the company's 2025 revenue to reach $86.07 billion, a 15.65% increase from 2024's $75.34 billion, and expect a non-GAAP EPS of $16, up 13.69% from $14.07. The average analyst price target stands at $287.90 with buy rating, with the highest estimate at $330, suggesting a potential upside of up to 15.81%. PGR stock price performance and valuation. At the time this video was created, the company's share price stands at $284.93, reflecting a 37.6% gain over the past year, well above the S&P 500's 12.7% increase during the same period. Over the past 5 years, Progressive shares have surged 266.8%, far outpacing the S&P 500's 93.6% gain. Despite this impressive performance, the stock remains attractively valued. It offers a modest dividend yield of 0.14% and trades at a trailing 12-month price-to-sales (PS) ratio of 2.13, with a forward PS ratio of 1.94. The stock's non-GAAP price-to-earnings (PE) ratio stands at 19.03, with a forward PE of 17.84, indicating reasonable pricing relative to expected earnings growth. Additionally, its price-to-free cash flow (PFCF) ratio is a compelling 10.62. Based on FinChat data, if we look at the valuation over the past 5 years, Progressive stock is currently trading with a forward PS above the average, a forward PE in line with the average, and a PFCF above the average. The forward PE suggests that Progressive is fairly valued and still has potential to rise. With a PFCF of only 10 and continued rapid growth, this may indicate that the stock is undervalued. Progressive growth potential. Progressive's growth prospects remain strong, driven by several factors. 1. Premium growth and market position. Progressive's Q1 2025 premium growth highlights strong market capture and customer acquisition. Net premiums written rose 17% to $22.2 billion, significantly outpacing industry averages. Direct personal lines revenue surged 25% to nearly $14.8 billion, driven by aggressive advertising and effective customer strategies. Total policies in force expanded 18% year-over-year to 36.3 million across personal and commercial lines, indicating successful penetration into new demographics and markets. As the second-largest personal auto insurer in the U.S., Progressive benefits from established scale and market presence. The top 10 insurers hold about 76% of the market, enabling Progressive to leverage economies of scale and invest heavily in technology infrastructure, strengthening its competitive position against smaller rivals. 2. Investment in technology and future capabilities. Progressive's Q1 2025 technology investments are central to its growth strategy but have pressured near-term margins. The company increased spending on AI and technology to automate claims processing and enhance risk pricing accuracy, causing a 41% rise in other underwriting expenses to $2.7 billion, double the premium growth rate. These investments aim to boost operational efficiency and improve customer experience by reducing claims, processing times, and enabling more precise underwriting, which should enhance loss ratios over time. Despite this, Progressive's expense ratio rose moderately to 20.2% from 18.3% in Q1 2024, but remains reasonable given the strategic focus. The company maintained a strong combined ratio of 86%, slightly improved from the prior year, indicating that better loss performance is offsetting higher expenses and that technology investments are beginning to support future profitability and growth. 3. Strategic initiatives. Progressive's Q1 2025 strategic initiatives underscore its growth potential. The Cargo Plus endorsement targets truckers, enhancing coverage and leveraging technological advancements in claims processing to streamline operations. This initiative is poised to expand service offerings and drive revenue growth in the commercial auto segment, despite challenges in the trucking market. Additionally, Progressive emphasized technology and advertising, utilizing efficient digital advertising and sophisticated risk segmentation to maintain competitive pricing. CEO Tricia Griffith highlighted the company's ability to adapt pricing at a granular, state-by-state level, enabling agile responses to market dynamics. These efforts, combined with tools like Name Your Price and Snapshot, strengthen customer acquisition and retention, positioning Progressive to capitalize on its strong market presence and sustain robust growth in a competitive insurance landscape. Risks to consider. While Progressive presents a strong investment case, we should be mindful of potential risk. 1. Investment portfolio risks. Progressive's investment portfolio, mainly fixed income securities and common equities, faces risks including interest rate changes, credit deterioration, concentration, prepayment or extension, and liquidity risks. Market fluctuations or issuer financial weakening can reduce investment values and income, causing realized or unrealized losses. A significant portfolio decline could weaken Progressive's financial position, lower earnings, and limit its ability to meet capital requirements or write new policies. 2. Competitive and regulatory risks. The insurance industry is highly competitive, with major players like State Farm, Travelers, and Allstate vying for market share, which may pressure companies' market share and profitability. Regulatory challenges, including restrictions on using rating factors like credit, education, and occupation, could hinder accurate risk pricing. This may result in underpricing or overpricing policies, negatively impacting underwriting margins and growth prospects in a highly competitive and regulated insurance market. 3. Economic and inflationary pressures. Rising inflation, particularly in auto repair and medical costs, can increase claim payouts, impacting Progressive's combined ratio, a measure of underwriting profitability. For example, in March 2025, the combined ratio deteriorated to 90.9 from 84.3 year-over-year, partly due to higher loss cost trends driven by inflation. Economic slowdowns could also reduce demand for insurance products. Conclusion: the Progressive Corporation's robust Q1 2025 performance, characterized by significant revenue and earnings growth, strong cash flow, and prudent financial management, underscores its status as a high-quality investment. With a solid track record, attractive valuation, and promising growth prospects, Progressive offers investors a compelling opportunity to capitalize on the company's continued success in the insurance industry. But remember, this is not a financial advice. What do you think about Progressive? Are you buying, holding, or passing? Drop your thoughts in the comments below. If you found this video helpful, please make sure to like, subscribe, and hit the bell so you don't miss my next stock analysis. Thanks for watching, and see you in the next one.